What if I told you that silver just broke records not seen in over 40 years, and most analysts believe we're only at the beginning of this surge? In 2025, while gold delivered an impressive 65% gain, silver absolutely exploded with a 150% increase. And here's the kicker. According to industry experts and major financial institutions, 2026 could be even better for silver investors. I'm your name, and in today's video, we're diving deep into why silver is positioned to outperform gold in 2026. We'll cover the supply crisis that's been building for 5 years, the industrial demand that's skyrocketing, the gold-silver ratio that's flashing major buy signals, and the geopolitical factors that are creating the perfect storm for silver prices. If you're interested in precious metals investing, you definitely don't want to miss this. Let's get started. 2025, a year for the record books. Let's set the stage by looking at what just happened in 2025. Silver didn't just have a good year, it had its best performance since 1979. The white metal surged from around $30 per ounce at the start of 2025 to over $70 by December, more than doubling in value. But here's what makes this even more remarkable. Silver finally broke through the $50 barrier that had held it back for over a decade. Twice before, in 1980 and 2011, silver approached this level only to fall back. In 2025, it didn't just break through, it shattered that ceiling and kept climbing, reaching as high as $92 per ounce in early 2026. According to investment experts, silver raised approximately $1 billion in institutional inflows during 2025. Major institutions that had ignored silver for years are now paying attention. The Sprott Physical Silver Trust, one of the largest silver funds globally, became a major buyer as institutional money flooded back into silver after years of outflows. Why this time is different? What makes 2025's rally fundamentally different from previous silver surges? 3 words: structural supply deficit. Unlike the speculative runs of 1980 or 2011, this rally is being driven by something much more powerful. The market is finally recognizing that there simply isn't enough silver to meet demand. 5 consecutive years of deficits. Here's the reality that's driving silver prices higher. The global silver market has been in a structural deficit for 5 consecutive years, from 2021 through 2025, and experts forecast this will continue through 2026. Let me break down the numbers. In 2024, global silver demand reached 1.16 billion ounces, while total supply including both mining and recycling came in at only 1.01 billion ounces. That's a deficit of over 230 million ounces in a single year, equivalent to Mexico's entire annual production, and Mexico is the world's largest silver producer. The 2022 deficit was even more extreme at 272 million ounces, marking the largest shortfall on record. According to the Silver Institute, 2025 saw a projected deficit of approximately 117 million ounces, and while analysts expect the gap to narrow slightly to around 30.5 million ounces in 2026, we're still looking at continued shortages. Why supply can't keep up? Here's something crucial to understand about silver mining. Roughly 75% of silver is mined as a byproduct of other metals like copper, lead, and zinc. This means that even with silver at record high prices, miners can't just ramp up production quickly. They're dependent on the economics of the primary metal they're extracting. Global silver mine production has actually decreased over the past decade, particularly in the major silver-producing regions of Central and South America. Even with silver reaching never-before-seen prices, it could take years before any meaningful new supply comes online. Above-ground silver inventories are running dry. The London Bullion Market Association and COMEX exchanges are struggling to maintain adequate silver stocks. This isn't a temporary blip. It's a structural issue that appears to be intensifying. China's export restrictions, the game changer. Now here's where things get really interesting. Starting January 1st, 2026, China implemented new export restrictions on refined silver. These aren't minor regulations, they're fundamentally reshaping the global silver market. Under the new policy, only large state-approved companies can export silver, and only after obtaining special government licenses. Exporters must have at least 80 tons of annual production capacity. These requirements effectively block hundreds of smaller and mid-sized exporters who have historically supplied global markets. Why does this matter? China controls between 60 and 70% of the world's refined silver supply. Even a partial restriction instantly creates a global supply shock. China is essentially weaponizing silver supply, similar to how they've controlled rare earth metals, except silver is both a critical industrial input and a monetary metal. This is happening at precisely the worst time for global supply chains, when inventories are already depleted and deficits have persisted for years. Silver's industrial revolution. While gold is primarily an investment asset and store of value, silver has a massive advantage that many investors overlook. Industrial demand now represents over half of total silver consumption. Between 50 and 60% of annual silver consumption comes from technology and manufacturing sectors, and this percentage is growing rapidly. The green energy boom. Let's talk about the sectors driving this industrial demand explosion, starting with solar energy. Each solar panel requires approximately 20 grams of silver for its conductive efficiency, and solar demand already consumed about 29% of industrial silver in 2024. The International Energy Agency estimates that global solar capacity will grow at an average annual rate of 17% through 2030. By 2030, solar photovoltaic technology is expected to become the foremost renewable electricity source worldwide. Just to put this in perspective, global solar capacity installations hit 380 gigawatts in the first half of 2025 alone, a 64% increase from the same period in 2024. China installed more solar panels than the rest of the world combined in the first half of 2025. The European Union mandated solar energy integration in new buildings starting in 2026. Saudi Arabia is constructing massive solar farms with plans to source half of its electricity from renewables by 2030. Electric vehicles and electronics. Electric vehicles are another major driver. Each EV uses up to 2 ounces of silver in sensors, wiring, and power modules. As EV adoption accelerates globally, this creates steady, growing demand for silver that has nothing to do with investment trends. The electronics and semiconductor industries rely on silver for its unparalleled electrical conductivity. With AI infrastructure, 5G networks, and advanced computing expanding rapidly, this industrial consumption continues rising. Medical applications also depend on silver's antimicrobial properties for instruments and coatings, creating yet another demand stream. The critical projection. Here's the key projection from the IEA. By 2030, the solar and EV sectors alone will consume half of global silver output. That's enormous. It leaves minimal supply for jewelry, coins, investment bars, and other traditional uses. Silver analyst Frank Holmes emphasized in December that silver's role as a transformative part of renewable energy is an outsized factor in the current price rally, adding, "I don't think that is going to go away." Industry experts warn it's dangerous to underestimate the level of demand yet to come from these growing sectors. Understanding this powerful indicator. Now let's discuss one of the most important metrics in precious metals investing, the gold-silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. It's a powerful tool for understanding relative value between the two metals. The dramatic compression. In April 2025, the gold-silver ratio hit an extreme level of 100 to 1, meaning it took 100 ounces of silver to buy a single ounce of gold. This was more than 2 standard deviations above the long-term historical average, a level that has historically proven unsustainable. Fast forward to early 2026, and the ratio has compressed dramatically to approximately 50 to 1. That's a decline of nearly 45 points in just months, and it tells the story of silver's explosive outperformance. Historically, the gold-silver ratio has typically ranged between 50 to 80 during normal market conditions. In eras when silver was used as currency alongside gold, the ratio was often fixed between 12 to 1 or 15 to 1. Even as recently as 1980, the ratio fell to around 17 to 1 during silver's previous major bull run. What this means for 2026. The current ratio around 50 is significant. Many analysts believe the ratio could compress further toward the historical range of 33 to 35, especially given that above-ground silver stockpiles have largely disappeared while the ratio remains elevated by historical standards. Major investment analysts are forecasting the ratio could fall to 70 or even 65 by the end of 2026 in their base case scenarios. If we see more aggressive silver buying or supply constraints worsen, some analysts believe the ratio could go even lower. One precious metals expert recently noted that with gold potentially heading toward $8,000 or higher in the coming years, and the gold-silver ratio normalizing, this creates scenarios where silver could outperform gold by 6 times or more, even while gold itself is soaring. Investment experts at gold-silver point out that silver is just 11.8 times away from its inflation-adjusted all-time high when measured against M2 currency supply. In simple terms, silver hasn't even begun to catch up to the amount of currency that's been created in the financial system. The return of investment interest. After nearly 2 years of outflows, silver ETFs saw inflows turn dramatically positive in 2025. Holdings rose by 18% year over year, driven by net inflows of approximately 187 million ounces. This represents a major shift in investor sentiment. But here's what's really eye-opening. Institutional buyers are entering the market in size. One precious metals dealer recently shared that a contact in Utah was asking how to execute a $100 million silver purchase. That's not speculative retail money. That's the kind of institutional capital that typically arrives before the broader public catches on. Meanwhile, retail investors are recognizing silver's affordability advantage. At recent prices around $80–90 per ounce, silver remains accessible to average investors, while gold above $4,000 per ounce requires a much larger upfront investment. During precious metals bull markets, retail buyers historically favor silver for exactly this reason, and this buying pressure helps compress the gold-silver ratio further. Federal Reserve policy and macro tailwinds. The Federal Reserve cut interest rates in late 2025, and market expectations point to multiple additional rate cuts through 2026. Lower real interest rates are historically bullish for precious metals, especially silver, which benefits from both safe haven demand and growth-sensitive industrial demand. A softer U.S. dollar increases global silver affordability for international buyers. Falling real yields reduce the opportunity cost of holding non-yielding assets like silver. And rising fiscal deficits combined with election-driven spending add long-term inflationary pressure to the system. Silver's unique dual identity, part monetary metal, part industrial commodity, positions it perfectly to thrive in this macroeconomic environment. Geopolitical factors. Geopolitical uncertainty continues escalating. U.S.-China tensions, tariff disputes, and resource nationalism are all contributing to safe haven demand. Russia and Mexico, responsible for roughly 20 to 21% of global silver production, remain geopolitical hotspots. Mining nationalization trends in parts of Latin America create uncertainty about future output. During the 2020 global disruption, silver surged 47% in a matter of months. The 2025 price behavior showed similar sensitivity to geopolitical shocks, and the setup heading into 2026 suggests this dynamic will continue. Where are prices headed? Let's talk about what experts are actually forecasting for silver in 2026. Current projections from financial institutions and precious metals analysts place silver's average 2026 price around $97 per ounce, with a consensus range of roughly $65 to $100. But many analysts believe these targets are too conservative. Bank of America raised its 12-month target to $65 per ounce after the rate cuts and ETF inflows strengthened. However, BNP Paribas suggests silver could climb as high as $100 per ounce by the end of 2026 as investors seek safe haven assets. Multiple precious metals experts, including Frank Holmes of U.S. Global Investors and analyst Clem Chambers, both see silver reaching $100 in 2026. Gold-Silver's lead analyst, Alan Hibbard, is even more bullish, stating he expects silver to perform better in 2026 than its 147% gain in 2025, and wouldn't be surprised to see prices increase by over $100 per ounce to $175 or higher. Some algorithmic models point to even higher potential targets. CoinCodex forecasts suggest silver could climb to well above $300 by mid-2026 in bullish scenarios, though these come with significant uncertainty. On the ultra-bullish end, Author Robert Kiyosaki has issued predictions of silver reaching $200, and some long-term analysts believe that if the gold-silver ratio returns to historical norms of 33 to 1 or lower, with gold potentially exceeding $8,000, silver prices could eventually reach even higher levels. The conservative versus bullish case. Conservative analysts suggest silver may consolidate between $65 to $100 through 2026, with potential pullbacks due to profit-taking as prices remain elevated. They caution that if industrial demand slows or companies find alternatives to reduce silver content in products, this could pressure prices. The bullish case, which appears to have more support among precious metals specialists, argues that the structural deficit is so entrenched and industrial demand growth so strong that prices have significant room to run. Even with prices doubling or tripling from 2024 levels, the fundamentals continue improving rather than deteriorating. What could go wrong? Let's be realistic about the risks. Silver is more volatile than gold due to its smaller market size and dual nature as both an industrial and monetary metal. Sharp corrections cannot be ruled out, especially as prices remain elevated and vulnerable to profit-taking. If the Federal Reserve unexpectedly raises interest rates in 2026 due to persistent inflation concerns, this could reduce demand for non-yielding assets like silver. Higher rate environments make other investments like high-yield savings accounts more attractive. A significant economic slowdown or global manufacturing contraction could reduce industrial demand for silver. If companies successfully develop alternatives or reduce silver intensity in products due to high prices, this could ease some demand pressure. The paper silver market, particularly futures and ETFs, can create price volatility that doesn't reflect physical market fundamentals. Some analysts note there's more demand through silver ETFs than actual physical metal above ground, which could create dislocations. However, many of these risks appear to be outweighed by the structural factors we've discussed. And crucially, even in more conservative forecasting scenarios, silver appears positioned to continue outperforming gold on a percentage basis through 2026. Why this opportunity matters. So let's bring this all together. Why will silver likely outperform gold in 2026? Number 1. A 5-year structural deficit that's depleting above-ground inventories with no quick fix in sight. Number 2. Industrial demand that now accounts for over half of consumption and is growing rapidly from solar, EVs, and electronics. Number 3. China's export restrictions removing a massive portion of global supply from markets. Number 4. A gold-silver ratio that has compressed dramatically but still has room to fall toward historical norms. Number 5. Renewed investment demand after years of outflows, with major institutional buyers entering the market. And number 6. Favorable macroeconomic conditions with rate cuts, dollar weakness, and geopolitical uncertainty all supporting precious metals. Gold will likely continue performing well. Major banks forecast prices reaching $5,000 to $6,000 or higher. But silver's unique combination of monetary and industrial characteristics, coupled with severe supply constraints and exploding demand, positions it to deliver outsized percentage gains compared to gold. For 2 consecutive years now, expert forecasts have underestimated how high precious metals prices would climb. If that pattern continues in 2026, current projections may once again prove too conservative. If you found this analysis valuable, please hit that like button and subscribe to the channel for more silver market updates. Drop a comment below with your silver price target for 2026. I'd love to hear your thoughts. And if you're considering adding silver to your portfolio, make sure you do your own research and consider your personal financial situation. The setup for silver in 2026 is unlike anything we've seen in decades. The question isn't whether you should pay attention, it's whether you can afford not to. Thanks for watching, and I'll see you in the next video.